the cognitive architecture of crisis, or why can't we see crashes coming? Many have argued that humans evolved in environments that were dominated by linear or cyclical change, and consequently struggle with three related but distinct phenomena that pervade and perplex modern financial and ecological systems. The first is genuine exponential growth, which can be seen in compound interest or hyperinflation events triggered by unbridled government borrowing and spending. The second phenomenon is non-linear feedback, where small inputs produce disproportionately large outputs through self-reinforcing feedback loops, such as the 2010 flash crash, a trillion-dollar stock market collapse triggered by an automated $4 billion sell order of futures contracts. The third, and arguably most consequential, is the so-called threshold-driven phase transition, in which a system absorbs stress invisibly before flipping into a new intolerant state. The most familiar of calamities, that of market crashes, fall within this third category, even though they are often described in loosely exponential terms. This distinction matters because it reframes the question of the pinprick trigger. The infamous roll call of market crashes reverberates through human history. On Black Monday in October 1987, the stock markets plummeted by a quarter, although it was not caused by any single piece of bad news in any way proportionate to the loss triggered. Rather, the market had become fragile through over-leveraging, overvaluation, and, crucially, the widespread adoption of portfolio insurance algorithms that automated bursts of selling when prices fell. On Black Monday, the trigger was almost arbitrary, and the vulnerability was the substantive cause. The same structural reading applied to October 1929, where margin debt and speculative market euphoria had primed the system to implode, and also to the global financial crisis of 2008, where opaque collateralized debt obligations and interbank dependencies created a network in which the failure of one severely over-leveraged operator, Lehman Brothers, sparked contagious distrust across the entire financial ecosystem. Sornet and Minsky have both argued that such collapses are caused by compounded misbehaviors rather than by external triggers. So why do supposedly intelligent, informed participants fail to act on these unstable market conditions, while other commentators such as Rubini, Michael Burry, and Nassim Taleb do? There are four mechanisms. The first is perceptual, in that humans genuinely cannot intuitively process compounding errors, or interest, as Wagoner and Sagaria demonstrated in the 1970s. The second is probabilistic, namely the systematic underweighting of tail risks that Taleb terms the ludic, or game-theoretic fallacy. In other words, the market isn't transparent and operates like a lawless jungle rather than a casino that can be mathematically gamed. So when black swan events materialize, mathematical models and algorithms fail to anticipate their consequences. The third is motivational, in which sunk costs, identity investment, and the sheer psychological cost of contemplating systemic collapse generate cognitive denial of unthinkable consequences. The fourth, and most often neglected, is a strategic miscalculation. Even those market participants who clearly recognize a bubble may rationally choose to ride it, because exiting too early is costly, even though the precise timing of a market collapse is unknowable. Abreu and Brunemeyer have argued that bubbles persist, not in defiance of rationality, but rather partly because of it, since no single trader can coordinate a synchronized exit. In summary, financial and ecological systems tend to accumulate fragility through processes that human cognition has not evolved to perceive clearly, due to compounding, non-linear feedback, and threshold dynamics. This perceptual blindness is further amplified by motivated reasoning, which makes collapse unthinkable, and also by strategic incentives, which make collective exit impossible. The precise trigger of any given crisis is therefore essentially unpredictable, while the underlying vulnerability is, in principle, entirely foreseeable. Thus, the challenge is to anticipate and act upon market bubbles rather than to guess precisely when they will burst, as any major power broker with sufficient leverage to disrupt global supply chains, freeze market liquidity, or trigger a globally contagious debt default could precipitate the next financial crisis.